With world-class expertise and local insight, Dexus creates value not just for today, but long into tomorrow.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB this Wednesday afternoon. I'm Juliette Sarli. Let's get you caught up on where the local market is tracking. We have not really gone anywhere here on the CBO 200 when it comes to the overall ASX 200 today. We look like we are finishing off as we get into match off up 8 points or 0.1%, 50-day high, so continuing to add to that gain that we saw yesterday, but certainly not the sort of relief rally that I guess we thought we would see, given that you saw some more optimism coming through both the S&P 500 and the Nasdaq overnight amid the temporary trade truce from the US and China. So a little bit of a rally rest, where we did see some good gains though, as the president of the US is in Saudi Arabia, was in energy stocks. We have been seeing a big energy boost with crude oil gaining. You've also got the likes of Woodside talking to Saudi Aramco about a potential stake in its Louisiana LNG project. And then we had some news too in terms of annual wages growth. The wage price growth in Australia increasing to 3.4% over the past year. The first time that wage growth has ticked up since the June quarter of 2024, but a lot of this driven by one-off increases in the public sector to award rates, particularly those in the aged care and also childcare industries. Let's have a look at the sectoral moves today, kicking it off with energy. Woodside, I mentioned, rising on news that it is in chats with Saudi Aramco. The banks, well, we heard from CBA, of course, with its third quarter numbers today. CBA continuing to rise, up 0.6%. ANZ was off by 0.5% today. Having a look at consumer discretionary stocks, particularly as we heard from Aristocrat today, that was certainly a laggard after its first half number was a miss. And in fact, at one point, Aristocrat was down more than 15%, set for its worst day in 15 years. Lottery Corporation also under pressure, Super Retail down by 1.8%. When it comes to some of the top corporate stories, of course, it was about the market leader, CBA, reporting an unaudited cash profit of $2.6 billion for the third quarter. That was flat on the average of the last two quarters and up 6% from a year earlier. ASIC suing Macquarie for what it's labelled repeated and systemic misleading conduct. Macquarie Group down by 1.2%. We should point out they're suing Macquarie Securities. Bain Capital pulling out of the takeover race for Insignia Financial, sending Insignia down 15%. Woodside signing a deal with Saudi Aramco to explore opportunities regarding its Louisiana LNG project. The pair also exploring a collaboration in lower carbon ammonia. And Jefferies says Aristocrat's first half earnings 6% below what they were expecting. Elsewhere, Webjet surging to a 5-month high. Shareholder BGH Capital apparently interested in acquiring a stake there, and Life 360 extending gains on its Q1 results, while Judo Capital up 3%, Citi lifting its sell rating to neutral. Let's get to our Wednesday guest, Mark Gardner from MPC Markets. So I guess, has the uncertainty been taken away? We've still got hope. What are you seeing in terms of the optimism from the trade truce?
Look, overall, this recent rally's got all the hallmarks of a bear market rally. I don't think there's anything really. There's no real catalyst. I mean, we're running mid-month. CPI is now out of the way. Earnings is out of the way in the States, largely. I think we may have Nvidia next week or the week after. So I don't really see anything derailing. I don't see it skyrocketing any further. I think we'll be somewhere around here, but I think we'll sort of drift sideways to higher until the next payrolls number, which is a little bit later in the month, I believe. I think it might be the 9th. So we've probably got about 2.5-3 weeks where it'll be a will we won't we situation, and then we'll just see what happens from there. But yeah, it's quite a remarkable rally, and quite a number of stocks going back through record highs. I think the risk reward at the moment, though, is probably nothing's really fundamentally changed. We've still got tariffs out there. We've made steps in the right direction, but trade deals aren't easy. But I think with someone like Trump at the helm, he's very clearly on a bit of a positive PR thing at the moment, and he's very, very good at that. So I would say we'll remain relatively buoyant for the next few weeks, but you just got to keep one eye on the bond yields. You know, I think those 30 years are still somewhere around 15 basis points from 18-year highs. Those long end yields are concerning. So the bond market's not believing it anywhere near as much as what the equity market is at this stage.
Yeah, and I think we have to remind ourselves as well that even though the tariffs have been lowered from those aggressive 145%, they're still 30% higher than where they were. Let's talk about our market. Everybody's been a naysayer about CBA. It continues to defy gravity. What is your thoughts on the banks now that we've had the trading update from CBA and, of course, the half yearlies from the other three?
Look, we don't really play in those big four, to be honest. If we would, we'd be playing in CBA. Our models, we wouldn't be touching it for quite a long way at this stage. There's far better options for us in the market if you want dividends, etc. We're not benchmark chasers. I don't really, you know, we try to make our clients money all the time, not just, you know, beat an arbitrary index. So, but we bought quite a lot of Macquarie on the dip in mid-April, and we've basically sold that. We've sold most or all of that, except for those who want to keep it long term, and switched to GQG actually a few days ago, which is pretty timely. So technically GQG looks pretty positive, you know, on the charts, and then also just continue to get FUM inflow, and I think it's probably that Adani thing was obviously just a bit of a stall or a little bit of a bump in the road in the long term. They've got a very good model, and I do like the way that they do things. It's a very new way of fund managing, and some unique way of going about it. So I think that FUM inflow will continue for GQG, and I think they were ex-dividend today, but they're up about 10 or 12% in the last week.
As we know, if you'd held cash during this turbulence, you probably would have beat the market. We've still got quite a lot of powder dry, don't you?
Well, we basically used all our powder during April, and we're probably back to about 30% to 40% cash probably, or thereabouts. And we'll be looking, and if we do see this turn into a bear market again, we'll probably be straight away rushing to those gold miners that have been absolutely, you know, belted and are probably oversold, but we'll just wait for the opportunity there.
Which specific names?
Newmont particularly, because they don't hedge, and they've got the most leverage to the upside. I think we got one of the smaller recommendations is Golden Horse, which is an explorer, and in the mid-cap range, I don't think there's too much really at the moment. We've got GDX ETF for the remaining. I think we've got about 3 to 5% in gold as it stands at the moment, but that's down quite considerably from where we were, 2 or 3 weeks ago. So we're a little bit wait and see at the minute. I don't really feel the need, you know, being in cash prior, picking up some decent names, and making a bit of money in a period which was super volatile. We've given ourselves a little bit of breathing room to probably just wait and see for the moment, and see if anything happens, because I don't see us rushing to the upside. Bull market rallies are normally a grind higher over a longer period. Bear market rallies are usually very short and sharp. So I think there'll be another buying opportunity at some stage, and we'll have our shopping list out yet again. It'll just look a little bit different this time.
Yeah, all right. Well, let's talk about some of the big names overseas. You've got Cisco, Tencent reporting tonight. Sony's profit rising on robust performance. I guess, what is all of this telling us too about the global economic picture?
Our global recommendations have been outstanding of late. We got into quite a few of the non-tariff affected gig economy things, and a few of the subscription services. Spotify, Tencent Music, Lyft was another really good one that reported, and I think rallied about 30 or 40% the other night as well. Disney had a really good report, and they're opening new parks. That business looks like it's turning around. So I think there's still some decent opportunities in the US. But yeah, the Mag 7's kind of nearly back to really being a little bit overvalued for what the risk is. So we're probably back on the sell side in some of those. But yeah, it's there is still some positivity, but you got to remember those earnings numbers were backward looking, and And I'd just like to see how this supply chain thing plays out, how much Trump has dented business confidence, etc. I mean, the flip side of the coin is that everyone may have a second wave of panic buying in the US because they're fearful that it may escalate again. So the numbers are going to be very jumpy over the next couple of months. And yeah, be a little bit of a spectator for a while, which is fine.
Yeah.
But we
toilet paper stockpiling. Imagine we've lived through 2 cycles of that in our lifetime. So Reuters is reporting that Tesla's planning to start shipping components from China to the US for the production of Cybercab and semi-trucks from the end of this month. So that's, I guess, one positive that you're starting to see out of the truce so far.
Yeah, absolutely. And for poor old Elon, for all he's helped, the company's been beaten down pretty hard. It has rallied back a little bit. I think the long-term growth in that company is more likely the robots. And not necessarily the cars. So I think there's some really unique technology in those, which I don't think will be easily duplicated like a car. So I think that'll give him Tesla a little bit more of a moat over a longer period. So obviously you would be hitting the start button again straight away because you very much had to act quickly. I think we might see spot shortages in the US in certain items, but I think they basically did a deal just in the nick of time. It was within 3 or 4 days where you would have seen, some pretty severe shortages in some things. And obviously with trade starting back up again, the ports and truck drivers will be more willing to start up again and obviously give more hours, etc. Because it is a very key economic driver, those ports. I think for every 4 containers it equals a job, I think the LA port boss said. And
sorry, repeat that?
The LA port boss said if every 4 containers that comes in, it creates a job in the US.
Okay.
So, but yeah, there was a really good YouTube thing of him laying it out, and there's some really good stats in there. But yeah, it was by the skin of their teeth they got that that some sort of pause happening.
Yeah.
What happens in 90 days? Who knows?
So that just brings me to another point, because I was reading it as well when it comes to travel, and we've heard these stories about people being turned away at the border in the US. Every 40 international visitors, this is according to Tourism Economics, which is part of Oxford Economics, every 40 international visitors to the US is 1 American job as well. So they've got to be looking at that downward spiral in terms of people wanting to go to the US. But have you noticed, corporate travel yesterday, Webjet today, there's been a turnaround in some of our travel stops.
Yeah, we've identified the travel sector just generally as a very high AI risk. So we're not in any travel stocks at the moment. It's one of the sectors we believe will be hit hardest first, because there's a couple of really competitive, AI agents that are going over there at the moment, which I've had to muck around with a couple of them. They're quite extraordinary. It's like having your travel agent with you. And 8 o'clock at night, you can go, I want to change my flight, and it just goes and does it for you. That's all you've got to do. So that's one sector that we're not really looking at too much at the moment. But look, the port jobs, the travel jobs, obviously the Doge cuts haven't really come through. Because I think if the redundancy packages are 3 or 4 months, they don't actually get recognised in the numbers until. So next couple of payrolls, there could be a couple of surprises. They've been remarkably resilient and then revised down the following month, which I think, a little bit dodgy in my mind. But we haven't had a negative payrolls number since December 2020. There's never been, so I think that would be a headline that would very much shock markets. And say obviously the travel cuts a lot of part-time jobs. The port as well reduces hours. You could see a surprise in those numbers, but I guess we'll just have to wait and see.
We will indeed. All right, thank you, Mark. As always, Mark Gardner from MPC Markets. Let's get to the stock of the day. It was CBA. Andrew Wallant from DP Wealth Advisory. Henry Jennings from Marcus Today joined Andrew on the call.
Having said all of that, saying it's a buy, these kind of prices, it is nosebleed territory and it is very expensive. So when I say a buy, I'd like to get it on the committee sort of horizon with a very tiny weighting. It's 11.5% of the index, a very tiny weighting. But then at least if it drops to 140 again, we've got the chance to add to that weighting. So there's kind of some method in my madness. for purely strategic reasons, I'm going to have it as a buy so that it gets on our list.
On purely the numbers basis, it's hard to justify buying CBA on these valuations. Ultimately, the thing is going up. The results weren't too bad, as Andrew was just talking about before, so why don't we have a conversation around whether it should be part? You know, like banks make up 25% of the index, and if there's not even a commentary around having a bank in there, isn't the index potentially on the back foot to begin with? So no, I'm happy to support it as a buy.
All right, so let's have a look at the leaders on what was a pretty flat day. And we touched on the fact that a lot of these tech stocks continue to rise. You've got Life 360 block there, Neuron Pharmaceuticals continuing on that rally that we've seen, and a lot of these healthcare players on this news that President Trump plans to cut the cost of US prescription drugs. Insignia Financial down 15%, Bain walking away from its takeover offer. Aristocrat at one point had its worst drop in 5 years after its earnings disappointed. In the small end of town, let's have a look at the leaders. Core Lithium, wow, look at that, up by 37%, and to the downside in the small end of town. You've got quite a lot of these material players coming under pressure. Brockman Mining, St Barbara, they're down by 8% and 6% respectively. Tonight, some earnings. You've got the likes of Tencent, of course, which is dual listed, but that big Hong Kong behemoth. Cisco also out, US April PPI due, and US April retail sales as well. Tomorrow, we've got the big one here, jobs data, unemployment expected steady at 4.1%. Also earnings coming through from Xero and GrainCorp. And just recapping where the local market has finished the session, hasn't really gone anywhere today. The ASX 200, meanwhile, just checking as to where that is. Look, it had a little bit of a more positive session, up 11 points on the close, a tenth of 1%, 8,279. And importantly, that's a 50-day high, really boosted by this big gain we saw in energy stocks, in the tech players, as I mentioned as well. But you did see a retreat in utility and consumer discretionary stocks, which weighed on the overall index. We will be back from 9:45 a.m. Eastern again tomorrow. Have a great evening and we'll see you then.